Hey guys, Crystal here. Welcome back to the channel. Today we're talking about business valuation. Let's dive in. Business valuation is the process of determining the economic value of your business today. There are 4 methods of valuation I'll be going over today, and that is book value, earnings multiplier, market value, and discounted cash flow. Now, valuing your business is not a black and white exercise, as you'll see. There's a lot of gray area. Think of it like this. If you go to Walmart and look at their TVs, you'll see a wide variety, right? And for the most part, all of those TVs will have different prices, $4.99, $6.99, $8.99, etc. Obviously, the brand and size of the TV will help determine its price, but why don't companies sell their TVs for $5,000 or even $10,000? The reason is because no one would be willing to pay that price for it, and therefore it is not valued at that price. A large part of business valuation is determining what a buyer or investor would actually pay for your business. Chances are, if you are just starting out and struggling to get sales and decided to sell your business a year from now, you likely won't have any buyers if your sales price is $1 million, unless there is some data to support that valuation. So the very first step in determining the value of your business is determining which method to use. The first that I'm going to discuss is the book value method. But before I do, please give this video a thumbs up and subscribe to our channel. As a CPA and co-founder of Life Accounting, I can tell you that we are an accounting firm dedicated to helping small businesses grow through effective bookkeeping and tax. And all of our videos help you do just that. Sound good? All right, book value method. The book value method is derived by subtracting the total liabilities of a company from its total assets. The book value approach may be particularly useful if your business has low profits but valuable assets on file. Assets are the resources in your business that help you earn sales, so things like inventory or cash. For example, if you have assets on your books valuing $100,000 and liabilities or debt of $25,000, the value of your business would be $75,000 under the book value method. If your liabilities are higher than your assets, then you would have a negative valuation, and essentially your business would be considered worthless until you either pay off your debt or increase your assets. The drawback to the book value method is that it does not consider a business's future earnings potential. After all, a lot of businesses don't have a lot of assets but still earn high revenue. And even a business with high value assets could have more to offer than just the assets that they have. The book value method, though simple, may not paint the entire picture of your business's worth. The second method I'm going to discuss is the earnings multiplier. The earnings multiplier method is based on the idea that a business's value lies in its ability to produce wealth in the future. The earnings or income of a business are used to value a business in this method. But you can look at earnings in different ways depending on what you include. Should you include taxes, or do you include non-sales income like interest income? In most cases, EBIT, or earnings before interest and taxes, is the measure used as earnings. So taking your total revenue minus cost of goods sold and operating expenses would give you your earnings before interest and taxes. To value your business using the earnings multiplier approach, you would need to evaluate your EBIT over a period of time, like over the past year. You would then apply a multiplier. The multiplier is usually a number between 2 and 7, and it gets multiplied by your EBIT. So if your earnings before interest and taxes, or EBIT, were $300,000 and your multiplier is 3, you could reasonably value your business at $900,000, or $300,000 times 3. A large part of this method is figuring out what multiplier to use. The most accurate way to determine what multiplier to use is to work with a business appraiser. They take into account a number of different factors to determine your multiplier, such as business size, industry, market trends, and business brand. You could also Google multipliers by industry to see the most current information on multipliers for your particular industry. The third method I'm going to talk about is the market value method. The market value method determines the value of a business based on the selling price of similar businesses. Regardless of the type of business being valued, the market value method studies most recent sales of similar businesses, making adjustments for the differences between them. For example, when valuing a retail store, adjustments might be made for factors such as the number of inventory on hand, foot traffic, and location. So for example, if other retail stores have recently sold for $750,000 in your area, it is likely that, with all else being equal, your retail store is valued somewhere near that number. There are limitations with the market value method, such as you may not be able to find comparable sales. If the sales data isn't recent, it may not reflect the current market value, or this method only works for businesses that can access sufficient market data on their competitors. The fourth and final method I'll discuss is the discounted cash flow method. This is a valuation method used to estimate the value of a business based on its expected future cash flows. Discounted cash flow method, or DCF method, attempts to figure out the value of an investment today based on projections of how much money it will generate in the future. The purpose of DCF analysis is to estimate the money an investor would receive from an investment or business adjusted for the time value of money. The time value of money assumes that $1 today is worth more than $1 tomorrow because it can be invested today and earn interest. Think about it like this. If someone offered you $1 million right now or $1 million 5 years from now, which one would you choose? $1 million today. Who knows what will happen in 5 years, so you would probably take the money today. Do you see how money today is worth more than money tomorrow? So going back to the DCF method, in order to conduct a DCF analysis, an investor must make estimates or projections about future cash flows and determine an appropriate discount rate. The discount rate is what determines what $1 in the future is worth today. And as we just discussed, $1 today is worth more than $1 tomorrow, or vice versa. $1 tomorrow is worth less than $1 today. So if the projected cash flows of your business is $100,000 under DCF, a discount rate would need to be applied to figure out the value of that $100,000 today, and therefore the valuation of your business today. The discount rate is a company's weighted average cost of capital, or WACC. WACC is a complex formula, as you can tell. Too complex for the purposes of this video, though there are online calculators to help you determine your WACC. Once you have your discount rate, or WACC, you would apply it to your company's cash flow projections, and it will give you the value of your business today. Some advantages of the DCF method are it doesn't require competitor or market research, and you can incorporate your assumptions and expectations about the future of your company into a DCF calculation. Some disadvantages of the DCF method are you use assumptions about your future growth and cash flow. It's tempting to make them overly optimistic. Changing your assumptions can create radically different future cash flows. And lastly, calculating DCF is a complex approach. Now you know the different business valuation methods. I hope I didn't confuse you too much. Ultimately, I would recommend you hiring a professional to help you value your business. As a business owner, it's easy to overvalue your business, and having someone else do it would create a more objective valuation. There you have it. I hope you enjoyed this video. If you did, please give it a thumbs up if you haven't already. If you have any questions, please comment them down below and I'll respond to them directly. Also, subscribe to our channel if you haven't already, and be on the lookout for more videos to help you with your accounting and tax needs. See you in the next video.